Moneylender has a system for tracking inventory items that you can then sell, and it will manage the cost basis on those items. If you repossess that item and sell it again, it can keep an updated history of that cost basis over time as you go into and out of loans. One of the most important things about this system is how the cost basis works. So first, let's take a look at what cost basis really is. If we make a new loan, we'll use round numbers to keep things nice and simple. In our new loan, we have, on the amortization schedule, we have $100,000 and we're going to make $66,1853 over the life of the loan in interest. Now, if that $100,000 loan was for a piece of property that we bought for $80,000, we want Moneylender to know that our cost basis was $80,000 on that loan. After we add payments to the loan, we'll have some actual money, and we can see how that money is supposed to be applied between principal, profit, interest, fees, that kind of thing. So if we look at the payment distribution, it shows $100,003 in principal, but we know that we only paid 80 for that, so we know 20 has to be profit, and you can get that number from the investor report when you choose a specific lender. We can see here's the 80,000 and the 20,000 split out where we receive principal, and discount earned is the principal on the loan that represents our profit because we bought the asset or the underlying note for less than the amount of the loan. If we had this same setup, but we collected a down payment, we can record that down payment on the same day that the loan was originated, and then we can include that as part of the discount being earned. So if we got a $50,000 down payment, first we record that it's $50,000 is part of the loan amount, and then we record that on the same day of closing, which would be 12/15/2021, that we received a principal only payment, and we can mark that as down payment. So now we're right back to essentially being paid off, but we have this record of $50,000 down plus $100,000. And if we said that this $150,000 deal where they gave us 50 and financed 100, if we said our investment in that was 120,000, Moneylender can do the math to show us the profit of $30,000 after we've been paid all the way off on this loan. And that discount earned is profit, just like interest. Now that we know how cost basis works relative to the principal on the loan, we can start looking at what the inventory tools will do to keep track of that for us. Under Other Records Inventory, we can set up a new item. Let's say I bought a patch of land for $100,000 and I'm subdividing it into 5 smaller plots of land. Each of those lots would then have a cost basis of $20,000. So we might put lot 1 in for $20,000, and let's say I want to sell it for $35,000. We can put in a date acquired of 12/15/2021. We'll leave it unsold. We don't have a sale price and we don't have a date. So now we know that we have a lot 1 that we plan to sell, and we're hoping to get $35,000 for it. When we have a borrower in place that's ready to purchase it, we can come back to the inventory, Other Records Inventory, click on lot 1, choose which loan wizard we want to use to set up the loan, and click Sell. Now, let's say that we talked him up a little bit and we're going to sell it for, let's make it round numbers, it'll be easier to follow, for $40,000, and they're going to give us a down payment of $10,000. And now we can see we're going to finance $30,000 on this loan. So we create the loan. We'll set it up for a year ago so that we can amortize it all the way out and see how things would work. And so once we finish that wizard, we see that lot 1 here has been marked as sold. We have our sale price and our date of sale. And it also created that loan here in the list of loans. We have it. We see just like the example I just showed you. We have a $10,000 down payment, a $30,000 loan, and over here we already have a $10,000 principal payment recorded. Additionally, the lender will already be populated with the cost basis that we set up. So Moneylender knows that this $20,000 that we've invested in this lot has resulted in a $40,000 sale, and it can calculate the discount earned as we receive payment on this. Right off the bat, we'll get a discount earned from our down payment, which we can see from the investor report. Here's our $10,000 down payment, and because it was $40,000 with on a $20,000 investment, it's split equally with the principal and discount earned. So of that 10, 5 is actually profit. As we receive payments over time, we'll just record all of the payments up to and including the very final payment. So now if we look at the investor report, we can see selling from the inventory is a shortcut for setting up all those other steps like we did with our first example. Here we have our $20,000 and $20,000. It's all split out and calculated for us, and they're a nickel short, but we don't really care about that. That's the example where you sell it and it pays off and everything's great. But what happens when halfway through the loan, the borrower tells you, hey, I can't keep paying on this. I can't afford it. Just take the property back from me. What we can do here is at the time that they make that decision, we go to loan, close loan. We can set the date of closing. Let's say they contacted us on July 18th of 2022. So we got our last payment June 15th, and then they couldn't make their July payment, and they told us, hey, you got to just take this property back. So it's going to give us the option to charge off the loan, but right before we finish, it knows that it came from lot 1, and we have the ability to return it back to inventory. When we finish that wizard, the loan balances back out. It gets marked as closed unsatisfied. And here on the settings, we can see the waived interest, and we can also see that the principal is adjusted off instead of being charged off. If we refer back to the investor report, we can see that of the payments, the $20,000 we originally invested, $12,276.16 is the principal that we recovered that came off of that $20,000 initial investment. Quickly doing the math, 20,000 minus 12,276.16 gives us $7,723.84. That's how much we still needed to collect to recuperate our full $20,000 investment in that lot. But what happens when we return it to inventory is that Moneylender makes a note when it records that. We can see the cost basis for it created a copy of lot 1 with an updated cost basis and the new date of acquisition. That exactly matches 7723.84 matches how much outstanding from our original 20,000 we still need to collect. We can then go and sell this item again from inventory, and let's say we sold it for 35,000 and they gave us another down payment of 15,000, and we're going to finance $20,000 on this. When we create this new loan for the $20,000 financed, the same thing happens. Lot 1 gets marked as sold at 35. We have our cost basis, and here's our new loan for that lot with a $15,000 down payment, $20,000 loan dispersed, and we can see the cost basis for the lender is set to that updated amount. So you can repossess and resell a piece of property multiple times, and using the inventory system, Moneylender will keep track of the basis. When you need to report how much profit you've made for the year, The investor report run for a specific lender will show you the discount earned plus the interest plus the fees you collected minus any charge-offs, which as we're recuperating this property, we're not actually charging it off, we're just recovering the asset. And that's how the inventory system works in Moneylender. Thanks for choosing Moneylender. Happy lending.